Welcome to episode number 34 of Daily Market Mastery with me, popular investor Christian Rauchenwald. As usual, in Daily Market Mastery, we use the Elliott Wave principle or Elliott Wave theory to try to predict market movements in stocks and indices, and therefore give you an insight in how I manage my portfolio as a popular investor on eToro. If you're curious, you can follow this link here that's also pinned in the chat and visible in the description down below to check out my personal track record. And you can use the stream/video description down below to find all the resources. So a link to the book for Elliott Wave Principle that you can read online for free or order a physical copy like I did. A link to the one-page cheat sheet, a link to my portfolio, and a link to all the softwares that I'm using and tools that I'm using to apply Elliott Wave Theory on different charts. That said, the last thing before we jump into it is actually to point out the usual disclaimer that you can see at the bottom, and that is everything that I share in this live stream/video, depending on if you're watching it live right now or as a recording later, is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. Now, last thing before we jump into the charts, first of all, it's Monday, which means we have our usual portfolio review. And second of all, there's going to be a change for the foreseeable future because I'm quite occupied with other parts of our businesses right now. And therefore, we're going to, for now, for the next couple of weeks, only have one episode per week, and that will be on Monday, where we'll review all the things that we've labeled so far and see where we've been wrong, where we've been right, and basically keep track of things. That might sound like a small step back, but to be fair, I actually think it's an improvement because we now reviewed 20 different stocks and indices and labeled them. And it takes a lot of time to keep up with what's going on, and adding more to that list. Well, we might do it if there is some stock that just piques my interest. Just feels like it will get too convoluted. If you have a stock that you want to have reviewed or so, you can always leave a comment in the chat or so, and then I will consider it to make an episode about it. But for now, we're going to focus on the positions that we actively have in the portfolio, and we'll basically have our weekly reviews. If there are some important developments, I might add a spontaneous stream in between to cover them. But this should also make it easier for the people that copy my portfolio on eToro right now to not have to watch an episode 5 days a week, but to be able to just once a week catch up with the latest episode to know what's going on. Now that should cover everything. And with that, I'm going to actually share my screen with you guys. And I actually should have checked first. Thankfully, our microphone is working. It was an issue last week. I actually did part of what we're going to do today already last week, and unfortunately only in the middle of the stream realized that after yet another update, yet again the microphone wasn't working. So here we are. Let's start off by looking at the portfolio. Now, as we can see, my 2-year performance is still 47% up. My 1 year-to-date record is minus 25, which is bad. We'll cover why and whose fault it is and whatnot later. I've mentioned a week or two ago we might see minus 25, so now we're in that range. So before we actually turn around, and that it's going to be interesting because we should have then basically the 5 out of 6 months in the red and 1 month, let's say, break even, because plus 0.33% isn't really a winning month. And followed by now, June might therefore still end in the red. I'm going to be honest about that. And then with July, August, September, October, November, December, we're actually expecting 5 to 6 green months that should get us another decent year. Obviously, or probably nothing like last year where we ended the year with plus 45%, but still good enough to beat the indices and the markets in general. Now, that said, there we have that we already have open. So there we have the portfolio right now. We can see, IEP. Let's work our way through the list, and I'm going to open the portfolio on the other screen for me, and we're going to work our way through the list how we have it in Motive Wave, which is the tool that I'm using. Again, you can find a link to it in the description down below. Now, first of all, in the SPX, so using the labeling from the latest Elliott Wave theorist, we are looking at something like this. And I mentioned, although this is a leading diagonal because wave 4 retraces in the area of wave 1, Usually the second wave would turn around the point of wave 4 here, somewhere in the area of wave 4 or at the end point. It could go a little higher. We can add a Fibonacci retracement here. We have a big one here that's right now completely irrelevant, but we get a Fibonacci retracement and just look at this wave 1 down here. And we will see that the 61.8 area is also usually, so 38.2 to 61.8 is usually an area for the wave 2 to finish and turn around. And in this case, we're slightly above it. Now, if this here, that's a combinative corrective pattern. So we have one ABC and then another ABC and then a third ABC now, yeah? And that's labeled then as WXY. As you can also see on the one-page cheat sheet, I'm going to share it for a second here. So it's linked in the description below. You can download this as a free PDF and print it. And Deskcam, there we go. Yeah, so yeah, some wires in the way. But as you can see here, where do we have the double zigzag would be, for example, labeled as WXY. Double three would be labeled as WXY. And yeah, that's pretty much the two possible corrective patterns that are labeled like this. It just means that we have not one corrective pattern like a simple zigzag, but we have a pattern that is like a zigzag, some other corrective pattern, not a expanding triangle, and then another zigzag, yeah, which in this case looks like we have three zigzag, which would then be potentially either like this, or you just call it triple zigzag in this case. No, not triple zigzag, because then we would have more waves. Sorry for that. So double zigzag is what we're looking at here. And switching back, so in a zigzag, very often wave A and wave C are identical, which means theoretically there could be a movement that takes us a little higher to that point here. Yeah, the value would be a little bit around 4,400. Yeah, we'll see this week if we're going up higher or if we indeed turn around perfectly around the point of wave 4 here. Either way, that means like for June, there will be a little bit more suffering as mentioned here in the SPX, and then we should see wave 3 start to develop as 1, 2, 3, 4, 5. Similar to this, not exactly like this, so it will not crash like that, because that 1 will also divide into 1, 2, 3, 4, 5. That 2 will divide into ABC or another corrective pattern, and so on. Yeah, so it will not happen that fast. It will play out slowly over the months here. Yeah. Now, how did we get in the mess that our SPXU position is now at minus 30%? The reason for that is, if you followed me for some time, you know that actually till February last year, my wife and I used to live in Ukraine, which means that in February last year, somewhere around here, we actually ended up in Germany. Yeah, so we went on a short vacation, in quotes, visiting family here, and then the Russian invasion started. We were stuck here, and we pretty much spent most of the year to just get settled here. Eventually, in May, we had to dedicate a week to drive to Kiev to clean out our apartment and get our stuff and so on. And it was a lot of administrative stuff and a lot of like really annoying things, bureaucracy and so on, to get settled here, set up a company here and so on, and like a million other things. Yeah, during that time things were still going well, of course, yeah, as we see, because it was still going in the direction that we were betting against. However, then we started moving against that whole thing, and I simply wasn't paying too much attention, because here it was still wave 4 and then wave 5. Well, and then we enter basically October, the end of the year, and we have that corrective pattern here. And yeah, like honestly, I didn't pay enough attention to consider that we will retrace that far, and therefore I figured it will be like, I don't know, like A, B, C, and we're gonna go down again. Yeah, and then we went up again. Then yeah, well, now we go down. Well, then we're not up again, and yeah, so that was my mistake here for missing here that we actually already finished wave 5 and that we're on the way up now, and not considering how far we might go. Yeah, like at this point we actually started the streams, if I'm not mistaken, so somewhere around here in February, and I really thought, okay, that's going to be it. So like A, B, C, for example, and we're going to go down. And then we started to go down, which was, oh yeah, I'm right, yeah, and that's 1, 2, 3, 4, 5, and which is wave 1, and then wave 2. Yeah, turned out I was wrong. And yeah, like that's why we are here right now. Yeah, like overall, however, especially considering the Elliott Wave theorist, so it's like a usually quarterly, sometimes a little bit more frequent issue from Elliott Wave International at elliottwave.com that predicts, or they have a ton of analysts and their labeling looks like this, and it's obviously has been highly reliable in the past. And therefore, I'm confident that this is it. Now, there's not much point right now. Like, there also hasn't been much point last week to say, yay, let's close the positions or hedge them and then wait for the downturn. Because it's hard to say if the downturn, it could have happened last week already here. We are already in the area close to wave 4, and it was the 61.8 retracement, pretty much exactly. It could have happened now this week, starting with this point. It could go a little higher. So like we basically just miss out on downwards movement. The chance to miss out on that is higher in that case, in my opinion, than to save a few percent temporary pending loss. Yeah. So yeah, that's the SPX. So we are in a waiting position. We either expect the turnaround to happen now, which would be perfect in terms of the wave 4 turnaround point, or to go a little higher and then turn around from the 4,400 mark roughly. Either way, we should see by the end of the week how things are gonna go. Yeah. Now moving on to the NDX, where we are pretty much in the similar situation. We have 1, 2, 3, 4, 5. And again, my own oversight to assume maybe that's already ABC, not considering that we would look for a retracement to wave 4, although that's a leading diagonal and not an impulse. Yeah. And then considering, oh, we already have, let's put a Fibonacci retracement in here as well. The Fibonacci retracement, there we go. And we see, okay, oh, we are in the 38.2 retracement area, which is also a point where wave 2 can turn around. Yeah. Yeah, not happening. Okay, so but again, seeing the beginning, 1, 2, potentially wave 3 starting, well, not playing out like this. So yeah, getting wrecked here as well. And that's why there we have in the SQQQ actually a 54% loss in our current position, yeah, which equals like minus 12% roughly on our portfolio, or minus 30%. Yeah, so from the entire minus 25%, our position in the SQQQ is actually responsible for 50% of our pending loss. However, here, same situation. Elliott Wave International says, okay, the corrective pattern looks like this. Now we would have to see which one is the high point here, up, wrong direction. So what's the highest here? High 14.6. 14.672, 14.662. So technically the last day up was the highest so far. And the question will be, will we go up a little bit further? Yeah, like that's for support and resistance level. So will we go up a little bit further to hit that support and resistance level, in which case we would have retraced into the area of wave 2, where there's also a case for it, but I would have to look it up in the book, yeah, because I don't remember it by heart right now. Or we turn around here. So it's exactly the same as in the SPX. We either will go up a little bit further here and then have the turnaround, which still would likely happen, yeah, like before the start of July, or we will start turning around right now. Yeah, so we'll see this week. Yeah, that wave 4 line is already irrelevant here, and that channel needs to be adjusted then. Obviously, the big point here, so in both in the SPX and in the NDX, is that once we have the turnaround, so we have that 0, 1, 2, yeah, no matter if 2 is here or 2 is here, once we have the turnaround, our wave 3 that will develop, it will take time. We see that this year took almost a year and so on, yeah, or yeah, like 9 months. And that's another 9 months roughly. So the third wave here will also take 9 months, a year or so, but it will take us below the trend channel here. There has to be a breakout from the channel, so we will see a new low in the SPX and the NDX, which obviously means we'll recover the entire pending loss, plus on top of that make a profit. And that's the point where I'm saying this is my opinion and not financial advice. Please do your own research, guys, because this is me applying Elliott Wave Theory, and that is what I believe in, and that is why I'm holding on to those positions. Yeah. Now, if we move on to the Dow Jones Industrials, where we have the S-Dow, which is currently at minus 8% for us, and here, yeah, we also zoom out to a 2-day chart here, 2-day. So, and then zoom in a little bit. So here the labeling looks like this, according to ElliottWave.com or Elliott Wave International, where I wouldn't have been able to label that, to be honest, yeah, because that would have tricked me. That's a flat corrective pattern where we have a new low, which if we were to look in an upward trend, it would be a new high. So where you have 1, 2, or 1, 2, 3, 4, 5, and then the corrective pattern is not ABC, but it's AB, and then wave C barely builds a new high. Yeah, like, and here we are, according to Elliott Wave International, now already in wave 3. Now it's going to be fun to label that, but it's probably going to be 1, 2, 3, or cannot be, so that has to be 1, 2, which makes it hard to label this. 1, 2, 3, 4, 5. Yeah, I mean, as a leading diagonal, that works. somehow. But yeah, according to Elliott Wave International, we're already in wave 3 here. And as wave 3, it means we cannot go higher than this point. Yeah, if we go higher than this point, then that labeling here is invalid. Yeah, I honestly haven't seen, I mean, I have seen in the book, there are cases for the 1987 or something, or 82 or whatever market crash, where Robert Prechter had to make adjustments to his labeling. So where his initial forecast was slightly off, not completely wrong, but slightly off. Yeah. So it's possible also that they made a mistake here, and that maybe that turns out slightly different. But overall, their track record is so good that I have zero reason not to trust it. Which means here we are again in the same situation. We should technically see it going down, but again, there is the potential we can theoretically go till 34,712.2 to still have a valid labeling. Yeah, which means our S-Dow position at -8% might also the next couple of days still suffer a little more before we either get that one invalidated. Again, I don't believe it because of the track record of Elliott Wave International, or it starts to go down and we actually start to make insane profits, because we have right now around 55% just in those 3 positions, which means if they start moving in our favor, it has a huge impact on our portfolio. Yeah. Now the Russell 2000, different story here. Actually, we also had a position with 10% of our capital that hit our stop loss, and we basically made like -2% on that position. And in the SRTI, so the ETF that bets against the Russell. And now in the Russell, if we zoom out a little bit, it's similar. Here, according to Elliott Wave International, that's wave 1, wave 2 already finished, and now we are already in the 1, 2, and now in the third wave of the third wave where we should go down. Yeah. Now the position that we opened, I timed it probably badly because we entered here, and we see now we hit the 61.8 retracement. And we hit the 20%, we hit the stop loss, which we shouldn't have. That's just, yeah, like my mistake, and we missed out a little bit on that corrective pattern or on that movement down here, because because obviously the SRTY, so the ETF that is the inverse, in quotes, slightly leveraged inverse of the RUT, so of the Russell 2000, unfortunately, doesn't move 1-to-1. Yeah, so it's very, very similar, very close. But either I mistakenly picked the wrong stop loss, so we shouldn't haven't had it here, but we should have actually been on that high, yeah, that's pretty much it. Yeah, so that's pretty much it. So I picked the wrong stop loss, and that position got closed, which means we closed it at -21%, unfortunately, out of the 10% that we invested, so -2% roughly, or -2.1% for the portfolio, when in fact we could have already recovered part of that loss. So I'm actually gonna add a reminder to later today, once the market opens, add another position there in the STRU. So in those 4 indices, we have pretty much similar situations, just different spots where we're at. So while in the Russell 2000, we're already in wave 3, off of wave 3. So we have the 1 and potentially now finished the 2. And if that's the finish 2, ABC, for example, or ABC, so WXY in some form, then we're now going to see 1, 2, 3, 4, 5 play out to take us to wave 3. On that small degree, that means we have to break out from this channel. Then we'll have a wave 4 that takes us back here. And then we have a wave 5 that should also take us lower. And then that actually should take us out of this channel, because this big third wave here should obviously break out and build a new low. So it has to at least go lower than that 0.1 here. But usually using the Kennedy channeling technique, we would break out from that channel. So yeah, and again, that's not going to happen in a day, but it's going to take time. Yeah. Now that's there. Now Shopify, we don't have a position right now, so we're going to skip it for this episode, because this episode will anyway go longer. So the next thing where we have a position is Black Knight Inc., and our Black Knight Inc. position is at -7. Yeah, where right now I've covered it in previous episodes, but my assumption is that this here is 1, 2, which means we would actually long-term, here we're talking from 2007 till 2020, I guess, yeah, or roughly 2020, yeah. So 3 years, and here we talk from 2020 to 2022, so another 2 years. So all of that is 5 years. So this year will also take time to play out. But if that is right, so if I'm right here with the 1, 2 labeling, then our wave 3 will take us out of this channel. The upside here is that our stop loss is very tight at 52, and we saw that the low here was 53.15, so we got close to our stop loss, but we didn't hit it, which means our labeling is still valid, and this could be 1, 2, 3, 4, 5, and now we have another A, B, C, and which means that would be 1, 2, 3, 4, 5. So theoretically, either we go up here and we actually see over the next couple of years a hugely profitable trade play out for us in Black Knight Inc., or we go further down and we take a small loss because our risk reward ratio is really great here. We opened Black Knight Inc., gonna check, we opened it at the first position at 64, the second one at 57, and as said, our stop loss is at 52, whereas our take profit would be more than 100% up. Then moving on, Ford is the next one. There we have a position, and we're currently at an 8.7% profit. And here it's really nice. That's one of the cases. So again, I get it wrong sometimes. Nobody gets it right all the time. Yeah, that's not there is nobody out there that has a 100% track record. What matters is either you get it wrong, you get it right so much more often than you get it wrong that you're profitable, or your winning trades are so much bigger than your losing trades. Yeah, and I think Ford we originally reviewed. I'm gonna check real quick. Ford we looked at on the 4th of April, which was April 4th. Let's check May. So we reviewed it here in that area, and I said this looks like WXY, where this here is a contracting triangle, where then this will play out as TE, and then wave E will be then the breakout. Now if we look here, that will be likely 1, 2, 3, 4, 5, which means we'll have a small ABC corrective pattern that might even take us down here to 1184 again, yeah, so $2 drop. Which will then be 1, 2, and then we will have wave 3, 4, 5. Yeah, so far that labeling checks out, which means, however, the bigger picture here, there's no point, in my opinion, to sell here and try to rebuy and whatnot. Yeah, because if we look at the overall picture, we have a similar situation. We have actually a better situation, because if you look here, the long-term historical chart is labeled as 1, 2, which means we're in a wave 3, and then within that third wave, we already finished wave 1 and now wave 2, which means we're in a wave 3 of a wave 3. And once we have the drop down to 12 done, we are in a third wave of a third wave of a third wave. And the third wave is usually the strongest, which means we would actually, once we have a correction here further down done, so ABC, again, to the area of 1184 potentially, then we would have a strong third wave, fourth, fifth, which will also be strong because it's the third wave of a third wave of a third wave. Yeah, and we'll see how it plays out. So it's really interesting. We got in trade at a good spot, and so far that one played out like really nicely. It took some patience to wait for. I mean, we said in 4th of April, okay, that's how it likely is. And then actually only 1.5 months later, we reached a point where apparently we finished as wave E. And which, by the way, when we look at contracting triangles, very often the bottom line is going to be a straight line. And if we take a horizontal line, now where is it there? Just so to look at it, so we see that while not perfect, yeah, we have a little bit of a breakthrough here, but pretty much the whole triangle behaves exactly like this. So so, and then here we very often, if we take a regular trend line in a contracting triangle, we can very often draw a parallel like this. Yeah. So anyway, so in Ford we're doing well. I don't see reason, as said, to take any profit because we expect a small drop, but it doesn't justify to try to hunt a better entry here. And moving on. So we have Ford, and then next one, GameStop. GameStop is a huge position for us. I'm going to also zoom out to 2 days here. It's not as big anymore, and it's actually in profit. I know in the portfolio it says minus 46%, but you have to keep in mind that in 2021, when the, in quotes, squeeze happened here, that we actually made so much profit that I had to close the position because it was making up way more than 25% of the portfolio. We actually finished at January with plus 60% thanks to the positions in GameStop. And overall, we think it looks like this, so that we have 1, 2, 3, 4, and wave 4 finished now. And I think before the earnings, I tried to label this in one episode, but I wasn't able fully to do that. Now, if we look at it, this might be 1, 2, 3, 4, 5. So wave 1, wave 2, potentially wave 3, 4, and that cannot be wave 5 yet, because wave 5 would need, in a leading diagonal, be a new high. Yeah. So 1, 2, 3, and then that might be 4 unfinished as A, B, C. We'll see how that plays out. but overall also bullish here. So not only based on Elliott Wave Theory, but based on fundamentals, considering that it's a debt-free business in a time when interest rates are rising and competitors have to suffer by paying higher interests on their debt, and that they have more than $1 billion on cash, a lot of inventory, and are actually trying new things to generate new revenue streams. So GameStop currently at a theoretical loss. Overall, if you've been copying my portfolio for years already, at a decent profit, and we're gonna see how that plays out. Moving on, next position, Domo. There we are currently, at plus 1.2%. And in Domo, we actually did take some profit because we entered here and then sold here again, because during the move up, I suddenly saw that this looked like 1, 2, 3, 4, 5, and decided to take a profit here. Now we re-entered here because we thought that might be ABC, because it would have been around wave 2 or wave 4 already. And however, it then turned out that it's more likely like this. Now the correction could still be ongoing. It doesn't have to be finished, to be fair. So we saw in other charts already that corrections can be longer. But so far it looks like this would be wave 1, wave 2, and now we're in the progress of wave 3, which means 1, 2. So there might be a little bit more downturn here, 3, 4, 5. And we'll see how that plays out. Overall, even if we ignore that labeling on very low degrees, on bigger degrees, we are in wave 3. And again, which would mean if this labeling here is right, then we're in wave 3 of a wave 3 of a wave 3, which means in Domo, if we are right, we would expect relatively big movements coming up, not tomorrow, not in a week, but in the not too far future, in the next couple of months. There should be some good news or positive segment or whatever it is that triggers that movement to get us like that bigger wave 3. Obviously, the biggest wave 3 will take years to develop. And again, we have an insane risk-reward ratio because our stop loss is here with that wave 2, whereas our take profit is outside of that big channel that's somewhere up here. So you guys can see up that this is really, now adjust that, like this. So that this is really something worth holding on to. Moving on, we don't have position in block hint right now, so we're waiting for my prediction to come true before we enter. We don't have one in Netflix right now. We have one in Disney where we're currently at minus 5.4%, where we think it looks like this. So labeling from 2002, we think that we have 1, 2, 3, and now wave 4, and we assume wave 4 has finished already, because that's the potentially 1, 2, 3, 4, 5, the potential wave 4 of the previous impulse wave of a lower degree, which would mean that we are expecting to go up here. Now, again, here the situation is that we have great risk-reward ratios because our stop loss is at, I'm going to check, is at 79.07, which might be this low. So this low here. We are right now at the 38.2 retracement. Well, this for me, again, I'm not the best when it comes to corrective patterns labeling. This for me is hard to label as a finished corrective pattern. So it's possible that we will fail this trade. It's possible that we go lower and we will take a small loss at 79.07. Perfectly possible. In which case, we would consider an entry around 40 again. It's, however, also possible that this actually is like this, considering that it's the 38.2 retracement. We have the previous wave 4, and that then basically our take profit is again a couple 100%. So risk-reward ratio great here. Now, moving on, next thing we have is actually NEO, where we currently, and in Disney, we are right now, as said, as a penny at a small loss of 5% of the 1% that we have invested. So, NEO, we still should get a chart. It's a waiting game. In NEO, I think that this is 1, 2, 3, 4, and now once that 4 finishes, either it already finished or we see it going lower, we go up from here. Our stop loss is at 565 because in an impulse, wave 4 cannot go into the area of wave 1. If that's the case, then we obviously would recover at least 70% of wave 3 in wave 5, and which means, again, risk-reward ratio is great because we have a very tight cut stop loss. with around 4 times that in take profit, or 3 point something times in take profit. So, but again, it's a waiting game to see how that pans out. Yeah, and I would say even if our chance here in quotes are 50-50, it's still good because our risk reward ratio makes it good. Yeah. Now moving on, we don't have a position in MU right now. We don't have a position in JPM right now. We have a position, no, we don't have a position in Morgan Stanley, but we have one in Goldman Sachs that's right now at a 5% profit. And here our labeling actually is like this, okay, that we say, okay, labeling from, that's a fluke in the data, labeling from 2008, that this is 1, 2, and we are right now in the process of wave 3. And then within that wave 3, this is 1, 2, potentially 3, 4, 5. So again, that actually, so that's supposed to look like this, not semi-log. That's why it looks a little weirder, yeah. So, and it makes more sense like this. So 1, 2, and we're in wave 3 right now. And in that wave 3, we have 1, 2, 3, and now potentially wave 4. And wave 4 here might still, where's our stop loss in Goldman Sachs? Our stop loss is at 277.84, which is that point here or not, yeah. So that's wave 4 finished, yeah. So we assume this is wave 4 finished. And now because we are at the 38.2 retracement almost perfectly, and we cannot go too much lower because the 193.60 would actually mean, oh, sorry, that's the bigger labeling. The 275 would actually mean that if it would go lower, then this would not be an impulse wave anymore, but it could only be a leading diagonal. And the third wave cannot be a leading diagonal. It can only be an impulse. A third wave always subdivides in an impulse, which means in order for that labeling to be accurate, we cannot go lower than the 277.84, which means from here, we actually would be looking at 1, 2, 3, 4, 5 to finish that fifth wave. Then we would have another retracement to wave 4 here, and then we would go up further. So far, we're up 5%. We'll see how it plays out. We can actually, if we look closer and really quick, get rid of that retracement here, but instead throw another retracement on the chart to give us an idea. We would have to look on a lower time frame to label this here as 1, 2, 3, 4, 5, yeah. If it's even finished. But we can see, for example, here that here we already have a 61.8 retracement, which is again 38.2 to 61.8 is the area where usually the corrective waves turn around. Sometimes they go further, yes, but usually they turn around here, and that would be the case, which means here we would actually expect it not to go down like this, but to actually from here have 1, 2, 3, 4, that could actually be an ending diagonal here, 1, 2, 3, 4, and now we would have wave 5. That wouldn't take us all the way up here, but that would then just be wave 1 overall of the 1, 2, 3, 4, 5 that takes us here, because we have to at least recover 70%, and if that plays out like an ending diagonal, it probably will not happen, yeah. Anyway, so there we are also good. And now IEP, the last thing, which is actually interesting, I made an episode about it on, it's episode number 32 if you want to check it out. And do we have one before? And actually episode number 16. Episode number 16 is what you want to watch. But there we had a fluke in the data source that showed us wrong historical data. Now I quickly need to update our workspace here to get some additional data. It's something I still have to work out to get the data sources set up so they always fit. And then we just clear the local data to reload it. And you can see it looks like this. And so when Hindenburg Research shared their analysis and said, hey, IEP is totally overvalued and should go down to $10, we actually had a fluke where this data here point went down to $10 roughly, and which would have then been wave 4. And so after labeling this, we also said, okay, it should go down to wave 4, but if we take the Kennedy channeling technique, undo that, 0.2 parallel through 0.1 and extend it, we said very often the fourth wave no, not fourth, yeah, very often the fourth wave here will touch the top of the base channel or sometimes the median, yeah. And we see here 1, 2, 3, 4, that perfectly happens here, yeah. And then we have the, okay, very often we turn around into in the area of wave 4. Unfortunately, I missed it by a day, yeah, because we still had that fluke, and then we just took a second look, and actually I compared it with Yahoo Finance and other sources to make sure that it was a fluke, and then we entered our position, which is right now at a 22% profit, and we opened it like 6 days ago, yeah. So yeah, so here we're basically now expecting, if that's wave 2 finished, that we now have an impulse wave, so third wave, which will play out as 1, 2, 3, 4, 5. And more importantly, in the long run, I mean, we see that wave 1 here is from 92 till 2014. So we talk about 20 years, yeah. And then wave 2 is from 14 to 22, so 8 years. So we obviously would expect over the next couple of years, potentially a decade, to reach a new all-time high here, yeah. And we'll keep an eye on it. If the 1, 2, 3, 4, 5 develops or starts developing here, then we have the benefit that we can double down. So if we have a 1 and then a 2, we add funds and end at 2. Then 3, we add funds at 4, as long as it keeps going our way. And we also have the benefit, if we're wrong, if that thing turns around now, that our risk is actually limited, because we have it at, our stop loss is at 18.03. So again, it's another trade with an insane risk reward ratio, yeah. And where Elliott Wave Theory tells us, hey, buckle up, yeah, you're not gonna get rich tomorrow, it's not gonna explode in a day, but that pattern is supposed to play out like this. And if it doesn't play out like this, then there has to be something wrong with the way I labeled it. But if you look at the specific episode, so in that case, the original episode, as we said, 16, but then the updated episode 32, where I actually covered yeah, the correction based on removing the data fluke that we had here. And then that's the result that we get, and that's just very, very promising. So in other words, we have a few positions where we're actually expecting to keep going up right now. We have a few positions where we expect the small corrections, and in our biggest positions betting against the markets, we might have to suffer a few more losing days. Yeah, part of the whole experience is the patience. Yeah. One of the main reasons for my portfolio to look the way it does, so to actually have that kind of track record, is that there is patience. Like here, when we made minus 13% in July, I mean, of course, maybe I could have predicted it and stopped the positions or whatnot, but I didn't panic because of it. And that was in a single month. Yeah, I know now we are a little bit more at a loss, but it's like not in a single month, it's in half a year. And I'm not panicking because I trust the process. I trust the system that has worked for me since the day I started the portfolio. And I trust the system that has worked for Elliott Wave theorists for decades, yeah, or actually for 100 years by now, since Ralph Nelson Elliott developed the system, yeah. And yeah, but so that's pretty much where we are right now. Like, we looked at everything. So IAP, Disney, Ford, Goldman Sachs, NEO, Domo, NEO we also looked at, yeah. Domo, Black Knight Inc., GameStop. Yeah, some of the positions are more promising. Like, for example, our IAP position looks very, very promising. Our Ford position looks very, very promising long term. Yeah, other positions are more like I don't know, hard to say, 50-50, 80-20, whatever, but like look okay in quotes. So the labeling checks out. I don't see any obvious mistake in the labeling, and our risk reward ratio is just too good to miss out on them. But if they turn sour, well, then so be it, because at the end of the day, the important part is this here, yeah. So while we have like less than 50% profitable trades right now, because our biggest position, SPXU, SQQ, and the SDAO and so on, they are all at a loss right now, where we have the most trades. But on average, our risk reward ratio is great, yeah. Now this is a little bit skewed, to be fully transparent here. The 900% is not fully accurate. That's probably caused because of we had a position in AMC, and there was a split off where you got a separate stock, and that stock was considered with 0% purchase. So even though it only was worth a couple dollars, it considered thousands % in value. But overall, our risk reward ratio is still highly or much better than for many others. Yeah. So I understand So like just to finish this up for today, I understand if for some people minus 25% is too much. If like that's, you cannot take that risk long term. If you're a short term investor, if you invest money for like you might need it in 6 months or in a year, then please don't copy my portfolio, because like there will be months, there will be quarters, or in this case there will be half a year of losses in between. If you're a long-term investor that plans to invest for a couple of years and actually wants to grow their wealth by investing, well, then you may want to have a little bit more of a let's say risk appetite. So be willing to endure a little bit bigger losses in return for much bigger profits whenever we are right as well. Yeah. But anyway, I mean, that said, I'm as I said when we looked at the SPX and the NDX. Part of the minus 25% that we have right now is definitely on my, or I'm to blame for that. Yeah, I mean, obviously I'm managing the portfolio, but I could have noticed, hey, wave 5 is finished. Let's close those positions. Yeah. But sadly, that was at a time where in my life, simply other things like settling in a new country and so on were way more important. Then keeping an eye on a portfolio where my long-term outlook is anyway bearish. Yeah. So I mean, it turns out it costs 24% of the portfolio or 25% of the portfolio, but basically at this point the thing was, okay, we still have so much bureaucracy to deal with. Yes, we're gonna lose a little bit temporarily, but I didn't expect that the correction would take that long or that it would go that high. Yeah. So so this is why we are where we are right now. But I'm actually very confident that while it might still hurt a little bit, the next couple of days, depending how we move in the SPX, NDX, DJI, and then the Russell, because those are going to be the positions with the biggest exposure. And even if we move very well in the IAP and Ford and whatnot, the percentages are just not big enough to counter those movements here. So even if we suffer a couple more percent of loss, I'm actually fairly certain that by July or at the end of June, we will start the movement in the other direction. And like as soon as today, potentially looking at the chart, but as late as the end of the month, we should start the 1, 2, 3, 4, 5 downwards movement, which will mean that on average, the next 6 months should actually be fairly or highly profitable. Especially if we consider that this year, so here we are in January 22, and here we are in October, so that was 10 months. And that here now was 8 months. So which means the next 10 months or so should actually take us below that line, or like roughly 10 months. Like it could be a little bit more, could be a little bit less. So let's say, I don't know, 8 to 24 months. So should take us far below or reasonably below that line. Which that's in all the indices, which means we would actually be hugely profitable. And at the end of the year, the worst case scenario would be, I don't know, for worst case end of the year, we have, where's like 24 here. Worst case by the end of the year would probably be, in my opinion, break even. Obviously, I cannot guarantee that because there are no guarantees in investing. But my personal opinion would be worst case break even, but potentially add a decent profit again. Anyway, so that's it. As said, from now on, or for the near or in the foreseeable future, the daily market mastery is actually not going to be daily anymore, but it will be Mondays every week. And we're going to use it to just look at a week's development of what's going on in the positions we have. Plus, additionally, in the positions that we didn't cover today, like SQ Inc. or so, check how the development is if we already hit the price levels where we would want to enter the stock and open a trade. And so that's it. Thanks for tuning in. Thanks for those of you that are copying my portfolio. Thanks for your patience and confidence. And I hope now you are more secure in your decision to keep copying. Those of you that are consider copying, well, you now know what I think is going to happen next, so you can make your decisions accordingly. And so thanks for tuning in. See you next week in another episode, or spontaneously if there's something big